good morning to everyone. My name is Oliver Blockland. I am the Senior Conference Producer at Global Investor Group. It's my great pleasure to welcome you all to the final day of the ISF and ISLA Securities Finance webinar series. Last week's sessions were extremely well attended, but if you did miss any of the webinars, they have been uploaded for you to view in your own time. Today's session is entitled Demand Dynamics, an Outlook for Beneficial Owners, Alternative Investment Managers, and Banks. On behalf of myself, ISF, and ISLA, it's great to see so many have joined us here again today for the final session. I'd like to thank our 17 sponsors. Their logos were up on the holding slide just earlier, who've really made this event possible. So do go to the Content Hub at the microsite where you registered to learn more about their genuine thought leadership and view white paper materials. In today's 1-hour web conference, we will have a quick presentation followed by a panel discussion of around 45 minutes, and we have set aside some time at the end for Q&A. We've already had a few questions come in for our panelists, so if you do wish to ask a question, you can do so by clicking the Q&A button. So do keep sending those through, and we'll try to answer as many as possible. I'd like to take this opportunity to thank the speakers and moderator for sharing with us your time and thoughts on the topics we'll be discussing today. The session is being recorded, and it is now my great pleasure to introduce Stephen Kiley.
Good morning or good afternoon, wherever you are. Thank you very much for that. So, as Oliver said, what we'll do is we're going to talk about demand dynamics, what has changed, what the current state is, and how we view that going forward. To start with, I will ask the panel to introduce themselves individually. So, if we do Nancy, Don, Paul, and then Jack, please. Off you go.
Hi, good morning, everyone. Nancy Allen. I'm the Global Product Owner of DataLend. For those of you who don't know, DataLend is the data division of Equilend.
Good morning, everyone. It's Don Duramo. I am the Global Head of Securities Lending for RBC Investor Treasury Services. Very pleased to be joining the panel this morning and looking forward to the questions.
Good morning, everyone. Paul McGuigan. I'm the European Head of Securities Lending at Scotiabank, based in London.
Morning, everybody. Very good to be here. My name is Jack Ingalls, and I am the Chief Executive of AIMA, which is the Alternative Investment Management Association. In previous lives, I've been both worked on the sell side and the buy side, having been a prime broker, as well as Chief Exec of a hedge fund company.
Okay, thanks everyone. It just occurred to me I didn't introduce myself to those who don't know me. So I'm Steve Kiley, and I'm the International Head of Sales and Relationship for Sec Finance at the Bank of New York Mellon. Without further ado, we're going to go into some numbers from Nancy. If we're going to talk about demand, then let's have a look at what has happened in the first half of this year. By anyone's standards, a pretty tumultuous year so far, and what the metrics tell us about the demand in the market so far, and if at all the new way of working is affecting that. Over to you, Nancy.
Great, thanks, Steve. Let's see if Oliver, you're going to share the slides. Great, thank you. So as Steve said, before we really delve into the drivers of demand, we wanted to first provide an overview of global revenue and market trends that we've seen in this unprecedented year. If you could flip to the next slide, please, Oliver. As you can see here, we've provided two sets of revenue numbers. We provided lender to broker and broker to broker. I highlight this breakdown as in the data space, we've been heavily focused on establishing standards and increasing transparency. In that vein, it's important when we publish the numbers, we differentiate between these two marketplaces. The lender to broker revenue reflects what we know as the traditional lending market. It's the revenue generated on behalf of beneficial owners. Whereas the broker to broker has a number of components and various drivers of demand. It reflects activities between dealers and across the broader financing markets. So it's important to note that these two numbers and the metrics behind them should not be added together because they do represent two distinct marketplaces. And when we're talking about securities lending performance on behalf of beneficial owners, it's the lender to broker data that is really relevant. And these are the performance metrics that the agent lenders use and scrutinize and used as part of performance discussions with their underlying beneficial owner clients. So just to clarify, all the slides going forward, we will be using the lender to broker revenue numbers. Okay, Oliver. So what's happened so far this year? Lots. As you can see, revenue is off approximately 14% compared to last year. EMEA and APAC have been heavily hit, down 33% and 25% respectively. I did a similar review back in May on another panel, and at that point I pointed out that no region or asset class escaped unscathed. But you can see that's changed now as the Americas has ended up 6%. So there are several key factors at play here. As the pandemic ensued, declining market valuations led to lower on-loan volumes in the equity markets, while short selling bans in Europe and Asia resulted in suppressed demand and fee compression. But in the Americas, we had a little bit of a different trend. Equity loan volumes did decline 14% year over year, but average fees increased by 22%, driven by a number of special names. And when we look at the top 5, coming in a future slide, you'll see 4 of the top 5 are from the Americas. There are also a number of COVID specials in the Americas that we'll highlight as well. Meanwhile, in EMEA, fees to borrow EMEA equities in mid-March averaged 43 basis points. That's the lowest at any point over 3 years. And that, again, was a result of large sell-offs in the global equity markets, but coupled with the short selling bans as well. But as we saw those short selling bans lifted, we saw a rebound in EMEA equities, and fees to borrow increased drastically throughout May and June. And as a result, through H1, the average fee to borrow was 76 basis points. Across fixed income, I'll highlight as well, fixed income was down 15%, but that was primarily driven by a decline in corporate bond revenue. Demand for US Treasuries and global sovereign debt increased, resulting in an increase in revenue of 6%. So let's put that in context, Oliver, if we could go to the next slide and see how does this year compare to the last couple of years. You know, as we look back, it's important to remember that 2018 was a record post-crisis year with gross revenue reaching 10 billion as we benefited from rising markets. But then as we entered 2019, we saw a long bias amongst alternatives as a result of global macro uncertainty. We saw the trade wars, we had Brexit, we had a number of central bank actions. And yet in hindsight, those issues look like nothing compared to what we have encountered so far this year in 2020. So we did see a bit of a recovery in the third and fourth quarters of 2019, specifically in the US equity markets where a handful of specials drove revenues higher. And that trend continued into January of this year. And then in late February, as we know, the world changed and the markets began what would be a 25% sell-off. And the implications to our revenue we just saw on the previous slide. So the next slide, I wanted to just highlight some COVID impacted securities. So on the left, we have oil and gas. And as you can see, the fee spiked from 50 basis points to over 200 in this industry over the course of a few days, with a corresponding increase in utilization. These then climbed to over 300 basis points. Now, while oil and gas did suffer as a result of travel restrictions, we know there were also other factors at play here, specifically Saudi Arabia and Russia ramping up production, which resulted in extreme excess supply, lack of storage, and negative oil prices. I've included a few names here from the oil and gas sector, just to give you an idea of some of the revenue generated by those specific securities. So you can see in Q1, California Resources generated about 3 million. That doubled as we moved into Q2. Chesapeake tripled from 2 to 8, and then Whiting Petroleum from 1 to 4. So that's some of the highlights of the names. Another industry impacted by COVID, transportation. We see here there was significant jump in fees again from less than 50 basis points as we entered 2020 to over 200 in early June, probably in May, let's call it May. One example here is American Airlines, which saw utilization jump from 55% while trading at GC levels to nearly 100% utilized and trading over 6,000 basis points at one point. Hertz is another great example, rental car company that filed for bankruptcy, and the average fees jumped to over 12,000 basis points. So some of the industries and specific names we wanted to highlight here impacted by the COVID. Okay, next slide. Over. I mentioned the demand for US Treasuries and sovereign debt, revenue being up 6% in that asset class. Just wanted to highlight here, and this is based on loan quantity, not market value, so not impacted by market valuations, but there was an increase in demand for US Treasuries once we hit the COVID hit in March. I wanted to highlight that. And then on the next, and that was demand for HQLA, and also to some extent, the need to raise cash. Okay. Next slide, Oliver. Cash this slide represents cash reinvestment. And as we know, in a cash collateral trade, the intrinsic fee is only one part of the equation. Here, I wanted to highlight the increase in revenue from cash reinvestment over the first half of this year. As you can see, following the Fed's 2 emergency rate cuts in early March, funds with more flexible cash reinvestment guidelines were able to capitalize on the duration mismatch and capture incremental revenue from cash reinvestments. So what we have here is the cash reinvestment revenue broken down by different beneficial owner types. And then to wrap up the revenue overview, on the next slide, please. Here we go. As I mentioned earlier, the top 5 names, 4 of the top 5 names are North American equities. We have Wirecard, which everybody at this point is very familiar with, is the one non-US name up there. But as you can see, if we look at the top 5 in 2019 versus 2020, 2019, the top earners pulled in generated 281 million, whereas the total in 2020 from the top 5 was 348 million. And finally, shifting away from revenue, but given the beneficial owner audience, on the next slide, please, Oliver. I just wanted to give an update. I'm sure many of you have seen these slides before, but what does the beneficial owner landscape look like in 2020 from a participation perspective? So we can see here, the average lendable is 20.6 trillion. That's 43% from collective investment vehicles, 24% pension plans, followed by governments, sovereign entities, and insurance companies. So that's the lendable allocation. If we flip to the next slide, we can see the on loan on average was 2.2 trillion, with pension plans holding the largest balances at 34%, followed by governments and sovereign entities at 29%. And collective investment vehicles have moved to third place. And that's really a reflection of the different collateral and investment guidelines that each of these plans have in place, with collateral investment vehicles tending to be more conservative. Okay, so that's back to you then, Steve.
Thank you, Nancy. So what we've got here today, we've got an outline. We've got an agenda to go through, but I'm obviously getting questions coming through as we go forward, and I will try and work those in and get those to the panel rather than just saving them up towards the end, because at the end of the day, I'd rather we talked about what the audience want us to talk about. I mean, Nancy, what those figures I think are really showing is that even if the sort of revenue line is relatively stable, we're seeing a lot more coming from the specials and a lot less from the flow business. It looks like, you know, the years and years everyone's been talking about a shift to intrinsic lending. It looks like COVID has moved us there rather quickly.
Yeah, there's. Go ahead.
No, go on. Go ahead.
No, yes, there's definitely that's where the revenue is coming from, is the specials. Also, some of the HQLA, as we said as well. But there is a high concentration of specials, and so when you look across the beneficial owner community, it really, you know, we say 14% down. There will be some who are doing a lot better than that, and there will be some who are doing a lot worse than that. It really depends on the composition of the portfolio.
Bearing that in mind, and I'll throw this out. This is more for. I mean, let's go to Jack actually, because you know he's at the sharp end of this. Bearing in mind what we've just seen, Do we think this is going to be a trend that will continue for the rest of the year, beyond? Do we see any changes in where the current demand is actually coming from? How has hedge fund behavior changed as a result of this, and how will demand to finance securities change for the rest of the year, Jack? What are your thoughts?
Thank you, Stephen. Well, of course, hedge funds are an integral part in the whole securities lending market, and they, like every other market participant, have been a bit roiled by what has been going on in markets, both in terms of market direction, but actually also in some of the government and regulatory intervention that's been going on in markets. It all given pause for thought. So I think, let's remember that there are so many different strategies within the hedge fund industry, so it's rather difficult to talk about them all as one unit. But let's start with equities for the first part. And I think, this massive amount of government intervention that we're seeing, similar and indeed more extensive than we saw post the global financial crisis, adds a layer of intervention into the marketplace, which makes it very, very difficult for market participants. I think what we saw in the 10 years after the global financial crisis with a lot of quantitative easing is that correlation between individual stocks fell out of the market like a stone. And there is a risk that that goes on again at the moment, and that all ships rise with the tide, as it were. And that limits the opportunity for certainly fundamental stock pickers in the equity long short space to find good opportunities. And I think there's some pretty hard evidence that it's been extremely hard for hedge funds to deliver alpha on the short side in the past 10 years or so. And I don't think that's going to change in a hurry. I think one of the other things, if I look at other hedge fund strategies like event-driven M&A, for example, there is definitely going to be a lot less M&A activity currently, or certainly that seems to be the case. So that is likely to dampen demand for that type of strategy. And indeed, it's in strategies like that where you tend to see the build-up of specials and obviously the higher fee-paying shorts. So I think that is also going to have an impact. And then when I think about some of the concerns that hedge funds would have, are some of the regulatory intervention that is likely to come. We've seen those short selling bans. Nancy talked about those, and certainly they have a dampening effect, of course, on short selling activity and securities lending activity. But they're over now. The 6 months are mostly over. They're still in place in Turkey and some places of Asia. But in the 6 major countries in the EU imposed them, they're over, but the threat remains that they could always come back. And I think hedge funds are going to be wary of that, and wary of how maybe other regulators might react. Behind that, just one last thing I'd say, Stephen, is that going on behind the scenes, there's a lot of scrutiny on leverage. ESMA itself currently have a consultation on the imposition of leverage limits where necessary. And indeed, beyond ESMA, in the world as a whole, the FSB are looking very closely indeed about the part that leverage can play in financial instability. So if you've got a risk of leverage limits being posed and caps being put in place, then again you've got potential dampening of demand in the future.
Just picking up on the short selling ban, Jack. If we look back at the financial crisis 12 years ago, and I remember thinking that the imposition of these things was a lot more significant than it was this time. I thought that a lot of the industry they were telegraphed, the short selling bans this time, and a lot of inventory was in place already, and that a lot of funds got their ducks in a row before the bans actually came in. Do you think they were more or less significant than last time?
I think they were definitely less significant because you didn't see them happening in the US, you didn't see them happening in the UK, and you didn't see them happening in Japan, three of the largest markets out there. And I think the lessons have been learned from last time, Stephen, which are broadly the reasons why those three countries I just mentioned did not put them in place. And I think that is a really, really significant positive, despite the governor of the Bank of England in the heat of March saying short sellers should just stop what they're doing. So it was definitively in countries where perhaps there was more political persuasion. I don't think they were particularly well signaled, and certainly they weren't harmonized in any European context, certainly when they were first put in place. And there was a lot of confusion because they weren't harmonized and they were somewhat different in country by country. Austria was different from France, for example, in what was permissible. And a lot of clarification needed to be made, which we worked hard to have made. So I wouldn't say that people had their ducks lined up there, but let's agree they weren't the most major developed markets that put them in place. I think if they'd happened in the US and the UK and Japan, then we would have had a much bigger problem.
Okay, thanks. Appreciate that, Jake. Thanks very much. Let's move on to Paul.
Steve, if I can, you mind if I just add a little comment? Yeah, just wanted to add a little bit on that point of the short selling bans. I think one of the different things this time around, Steve, you mentioned 12 years ago and today, I think one of the other points is the broader discussion that's happening around the short sell bans. You know, you look back at the credit events of 07, 08, and when the bans came in then, or at least were put in place, primarily the discussion was within the industry, insofar as how effective they were or they would be, et cetera. Today, you see that discussion on a much broader level. It's as Jack mentioned, there's different opinions and views within competent authorities themselves, but also a broader discussion around the effectiveness of bans. So I think that's one key point that's a little bit different this time around as well.
Excellent. Whilst you've got the microphone, Don, do you want to give us a quick update on what you saw the first 6 months, how the demand trends changed, what that meant for your beneficial owners?
Yeah, I mean, it's pretty well in line with what Nancy was saying from a numbers perspective. I mean, I think first of all, you know, this industry is very, very resilient, and when there's conviction in the market, you see, you know, demand manifest itself very quickly. We definitely saw demand sector-based, as Nancy alluded to, for either greater utilization and spreads. So that's kind of just the natural evolution of what we see within our industry. So that doesn't change. You know, some of the actions by the central banks, obviously providing liquidity to the market, did have an impact with respect to HQLA. We did see, you know, a tightening of demand there, as well as an increase in opportunities of spreads. But having said that, I think, you know, the key point I want to make here from a demand perspective is kind of the other way around, looking at supply, as you say, Steve, is the beneficial owners. And they're a key component in this whole value chain. And so when the volatility came into the marketplace, obviously we saw a lot of a major spike in volumes, a lot of sell activity, a lot of recall activity. Clients themselves were reassessing internal risk-based decisions that could potentially change their views within their securities lending mandate. So a perfect example is a lot of funds would look internally for funding changes and potentially impact the supply of HQLA through the traditional agency lending program. So we saw bits of that. Demand, as I say, was very sectoral based, and then collateral. We did see some trends, even though Nancy showed the spike in reinvestment returns, largely due to you know, reinvestment programs that would have that latitude to grab some of that spread. But we definitely did see an increase in non-cash lending, a definite direction towards more non-cash. Looking at illiquid collaterals, you know, in the high yield corporate space. ETFs was another trend that we saw increase, whether it's borrowing for hedging purposes or also ETFs as collateral. So those are kind of the real high-level impacts we saw with respect to the client's view. But the one last thing I want to make on clients is, we've seen this type of direction manifest itself before, right? It always comes down to the broadening of collateral, the discussions with clients, ensuring that they understand why the demand is changing, and looking at having them, where they possibly can from a regulatory perspective, look to expand collateral so that they can capture that spike in demand. So there's a lot of communication with clients through this process.
Actually, picking up on something you said there around collateral, specifically cash, non-cash, etc. I'd like to go to Paul. Paul, get your view on how you saw the first half of this year pan out in terms of, were there significant trends towards non-cash, cash? How has the demand changed in terms of what people have got to give beneficial owners in order to get that borrow in? I mean, Andy Dyson said the other day when we were all talking, no one ever borrowed anything that someone didn't want to lend, and that's true. But do we feel that supply and demand, in your experience, do you think supply and demand are converging or diverging?
And the first point, there's been a trend towards non-cash for a long time. I think what we saw come March was a slight shift in the behavior of that non-cash collateral, which was probably part of the reason you saw the numbers on the US Treasury. So the equity devaluation that we had internally and across the street, the margin calls that were swinging left, right, and centre throughout the day, that led to a large increase from what we saw with a shift towards using bond collateral. The assets that held their value, lower turnover, lower volume, to manage and meet those margin requirements that are necessary for our business. So, and obviously second to that was the utilization and redeployment of cash. Funding was abundant. It was cheap, and it was there to be deployed. So we saw a shift away from equity collateral, which is kind of where we have been pushing for a long time, towards some of the bond utilization and cash utilization. You can see the bond utilization came back off fairly quickly on Nancy's chart as the equity value came back up, but also as people got used to the new work from home environment. I know what we saw on our side, and it was probably similar to some other market participants in terms of the transition to working from home and some of the collateral management and timings around that. There was a need to meet margins, and we had to do that as quickly as possible. And bond assets were what we deployed. In terms of whether there's a divergence away from the supply and demand, in the short term, I'd say yes. From our side, we have seen a skew towards the long side, which is kind of to be expected. But we've also seen an increase in clients looking for mutually beneficial client solutions. So there is an increased dialogue in terms of as the costs go up for market participants as technology improves across the board, trying to be as efficient as you can. Counterparty to counterparty client versus ourselves, etc. So I think there is a divergence now in the short term, and I think that will close as the gap as we see market participants on the agent lender side and beneficial owners be more adaptable to some of the collateral schedules that Don referred to in terms of be it ETFs or fixed income or convertible bonds. So I'd say the more that changes, that divergence will reduce.
Okay, thank you, sir. Now, I'm going to go to some of the questions actually that have been coming in, because I think a good one's just come in, and it is something which is definitely going to affect both supply and demand going forward. We've been on this call 30 minutes exactly, and no one said those three letters yet, so let me do it, ESG. I'll put this to Jack initially, and then we can bounce it around. Jack, there's a huge trend towards ESG, certainly outside of the US, and it's going to affect supply a great deal, I would imagine, going forward, both on what's available and what people are willing to take as collateral. How do you see it affecting the demand from your side?
So I think ESG is here to stay, and as a factor in investment decision making is only going to become more and more important. I think one of the questions that gets raised quite often is short selling compatible with ESG? And I would argue it is not just compatible, but it is absolutely essential in continuing this ESG trend. Funds have to be able to express themselves both on the long and short side, particularly in an active way to affect change to get us further towards a more ESG friendly world. And actually, we at AIMA, we're producing and we'll be publishing actually very soon a paper which describes just that, why short selling is compatible with ESG. I think certainly the message has been got from investors in hedge funds and therefore hedge fund managers themselves, is that they will need to demonstrate an awareness of ESG and where appropriate, what they are doing within their investment portfolios. And there is also regulatory change currently going through, which means disclosures on the ESG side will have to be made, whether you're actually managing an ESG mandate, dedicated mandate, or not. So I think adding a new factor, so beyond growth and value and momentum and all these other ones, you've got a very important new factor, which will increase demand for certain securities, both on the long and on the short side. So I think it's very important, Steve.
Excellent. Let's flip straight across to Don. Don, I don't know about you. I certainly these days, I rarely, if ever, see an RFP that doesn't ask about proxy voting and if beneficial owners can get assets back on time, and if there's any automated way to do this, etc., etc. Have you seen an increase in that?
Yeah, I mean, to pick up on the theme of VSG, which I wholeheartedly agree in the sense that it's here, it's here to stay for the obvious right reasons. But embedded in that, I think the good news is if you think of a traditional agency lending program, and Steve, you'll know this, is one of the key tenets is really around understanding the goals and objectives of your underlying client, beneficial owner, and tailoring a plan around that. So things around recalling for proxy voting has been in existence for a very, very long time. The way that gets delivered is very efficiently. The way it manifests itself is really what the actual point from the beneficial owner would like to achieve. So there's various paradigms out there where you'll have beneficial owners that will want to recall for voting all the time, and you'll have beneficial owners that will want to recall only when there's contentious issues. But again, that is a decision or a risk appetite decision that the client will be making. As we move forward in the proxy voting around the governance of this within the scope of ESG, it opens up the discussion point around, what does the supply side look like if we move to an environment where most, if not all, are recalling around proxy voting. There's definitely an impact on demand there. There's definitely an impact on pricing. So I think, although we have within the industry an ability to manage around that, it's yet to be seen the longer term impacts if in fact this will become the norm as opposed to right.
If we go across the Paul, what about or how do you see the collateral space moving forward, where you've got demand to borrow certain assets, and you go to the agent lenders and say, this is what we need this, and we've got all this collateral we can give you, and then the agent lenders come back and say, yeah, but my client won't take that, and that, because that collateral doesn't fit within their ESG set. Is that doable? Is it workable? Is it going to change the way we do business?
It's tough. I'll be honest, it's tough, and we've seen the ESG tri-party schedule changes trickling through in the last few years, and for the short term and now it's manageable, right? Because we've got a diverse borrowing pool that we source our liquidity from. But as that shift continues, and I mean, on the reverse of that, as the supply base shift potentially shifts towards ESG assets, then it's going to become harder and harder to manage, and there may be some price or even some costs associated to that. That's kind of where we need improved transparency with respect to the assets that are being lent on the first instance, as to whether they are callable, similar to how some markets trade in Asia. There should be, I mean, callable flags going out on most of the securities. There should be differences in pricing on most of the securities, which I don't think, again, no disrespect to Nancy, I don't think that transparency on stability is in some of the vendor systems at the moment. But in terms of managing it, I think we have to look and rely on the tri-party agents. I think that's where we are looking to move our business. So that's kind of where we need it.
Let's move on to Nancy on that one then. So Nancy, yeah, you've been name checked there. But is this a trend that you see, and is it something which you think the vendors like yourself are going to have to not necessarily do something about, but be at the forefront of getting that information so there is more transparency? And generally, how do you feel that the tech space in itself is going to have an impact on demand in the future?
Yeah, so just, on the ESG front, I agree with Paul and Don that ESG proxy voting is absolutely compatible with securities lending, but it is going to get more difficult as the market becomes more fractured and there are so many different parameters put in place. At Equilin, we've partnered with ISLA's Council for Sustainable Finance, and we're looking at, really from a data perspective, how can we help to bring that transparency to the market? How can we help beneficial owners understand and benchmark or use performance measurement to understand how they are performing when you look at the ESG guidelines that they have in place as well? So that's something that's on our radar and we're looking at. But again, because every client has a different ESG profile, it makes it very difficult to bring the standards to market. From a technology perspective, and I'll take that question more broadly, Equilin's been a technology partner to the market for almost 20 years now. And so we've seen firsthand the investment that the market as a whole has put into technology and has put into the business to bring more efficiencies to the market. And what was really great to see, and I think everybody in the industry feels this way, is when we hit COVID, and all of a sudden everybody's sitting by themselves in their homes all over the world, we didn't miss a beat as an industry. And we saw flows increase over our trading platform as the market transitioned into the new work environment. So that was really, really great to see that investment has paid off. And then thirdly, I'd say the need for transparency, which is driven by technology, the need for data. Don touched on this. Beneficial owners over the course of the crisis have become much more involved and are thirsty for data and for information. And we've been, what we did is we started putting out daily updates to the market, whether or not you're a Dayline client or not. And we ended up doing a lot more bespoke analytics and reporting with the agents and the brokers and the agents on behalf of beneficial owners. So the technology stood up, has been and continues to support the marketplace, and the demand for data and for information was met, I would say, over the course of the last couple of months.
Okay. Now we've had a very good question come in, and if we can, let the answer be the last thing we talk about ESG, because I don't want it to dominate this, but it is very important. Someone has asked, over the past few years in this industry, we've had two-tier pricing to an extent. One price, and when I say pricing, let's say to a beneficial owner, one fee split if you're indemnified, another fee split if you're not. Or from a borrower, I'll pay you this much fee if it's title transfer, this much fee if it's pledge collateral, et cetera, et cetera. In a future state where there is some commoditization of collateral sets, and there are known ESG collateral sets, Do we feel that there could be two-tier pricing there, as in I'll pay you this if you insist on ESG collateral, but I can pay you more if you don't? And I'll throw that open to anyone.
Yeah, no, I was going to say two-tier pricing is a good point. I would like to say, though, first of all, I'm not entirely convinced we've seen, if you think about stable supply, I think Paul would agree, stable supply is what, our counterparts would probably put a lot more value on. And stable supply probably is the genesis of agent lenders, but I'm not convinced that agent lenders at times are getting the value sometimes with respect to if you're looking at pledge versus title transfer, et cetera. I think that's still evolving. But yes, I would say there could be an opportunity for two-tier pricing within ESG. But the last thing I'll just quickly say on that is sometimes that ESG or the governance discussion is very binary, and it's not really about revenue. And when it's a governance issue, or if it's an issue around voting, sometimes the revenue isn't really even a factor for the beneficial owners. It's really about performing and ensuring that they're meeting their own internal governance procedure. So, yeah, two-tier pricing could happen, but I think it's a much more complex discussion than just pricing.
Okay, Paul?
Yeah, I'd agree. I don't really need to go on too long about this, but yeah, it's something that I think if it comes down to it and it's the only thing you can offer, and you mean your lending assets are only within that, then I think two-tier pricing is something that you would probably have to be involved with.
Okay. At the start of this, we talked about some of the, Nancy mentioned it in her metrics, and then Jack touched on it as well. We saw some big moves in terms of central bank and state intervention in the market in order to keep the liquidity there. From the perspective, and we saw from Nancy's graph how much this affected cash collateral or returns from cash collateral, for example. How do we feel that will affect demand in terms of liquidity in the future, in terms of what is needed to be funded and what beneficial owners have got? Because I think we've all seen some of the beneficial owners hold back on some of their government bonds in order to keep them for liquidity purposes. And also around about mid-March, we saw some significant sell-offs from the asset owners in the govie space to take some profit on those. And either fund redemptions or get into equities because it was a good buying time. Do we feel that is something which is here to stay? Or do we feel that the central bank and state intervention is a one-off and that will recede and that trend will go away? I'll throw that open to anyone as well. In fact, Don might have more of a view on that, sitting in the middle as an agent lender.
Yeah, I'll comment on that. I mean, adding liquidity to the market from the central bank perspective, I think, is first and foremost important to ensure that they're doing everything they can through these volatile times. The derivative, the downstream impact could be exactly what you said with respect to beneficial owners changing, and we have seen beneficial owners change their views on what is going to be made available for loan given their own internal purposes. So I think that is still to come. But if we think back to what we said near the beginning in Nancy's presentation, you look at the flow business and the general collateral business kind of on the way down, and it's really more about optionality and events and deep intrinsic value specials. I think what this will change potentially or continue to evolve is the importance of the ongoing conversations with beneficial owners to be able to capture that. So, automation of general flows should be and probably is in a good space right now in the industry and can continue to improve with more technology. But I think the opportunity then becomes the connectivity with the beneficial owners, which is a key part of this evolution insofar as optimizing their portfolios as they change due to market events. The last thing I'll say on that is not related to central banks, but related to the market. The one thing we didn't really touch on was the impact specifically in Europe on the seasonal business and, dividends being canceled or postponed. That has probably been one of the largest, I think, impacts from a revenue perspective for beneficial owners over the past 6 to 8 months.
Yeah, we should probably expand on that, Paul or Jack. Is the cancellation of of a lot of the dividends and the move to more scripts, et cetera, has this fast forwarded the death knell of the seasonal activity?
On my side, we weren't involved in any of those trades, but I think what you could suggest or what you could talk about is in terms of the there is obviously internal strategies in terms of maybe EFPs, for example. So what it highlighted was the cost of carry is fine, and I mean there's a value to having your own internal inventory for collateral purposes or whatever it may be. But I think the dividend cancellations, some of them post the event, I think that raised awareness of the risk more so than previously before. So potentially you may see reduction in some of these internal strategies around dividend season, which could essentially lead on to increased demand on the beneficial owner side. But I think in terms of your original question, I don't think that trades have been for a long time. So
yeah, agree. Okay.
Yeah, I'd agree. From the hedge fund point of view, it's not a strategy that's pursued. This is one that's been very much done internally at banks, and from where it is now compared to say 10 years ago, it's a fraction of what it once was on a seasonal basis.
Yeah. Now again, and I'd like to go to Nance for this to start with. We've got to bear in mind the topic of this discussion today is demand dynamics. So put working from home to one side. What changes in practices and the way we do things have changed since COVID that we think if there was a vaccine tomorrow and everyone was back in all the major financial centers within a month, what has changed and what will be here to stay? Nancy, from a tech perspective, what do you think?
Well, the reliance upon technology, I don't even know if the right word is reliance, but the use of technology and how we found it to be so beneficial throughout this crisis. We have our regular client interaction calls. We do video calls with clients. We've actually started having virtual happy hours with clients. So you've seen that these type of video chats can be really beneficial, and I think that will continue to stay. I mean, just as a little anecdote at Equiland, I've never used the phone since I've been there. Whether I'm in the office, we talk to our offices over Jabber, over Teams, over video chat, and now we see the markets doing that as well. I think that'll continue. I also would say there's greater scrutiny around our processing, and when where we're behind in the securities lending is really in the post trade activity and reconciliation. And, we have armies of people behind the scenes dealing with reconciliations, and there has to be a more efficient way to manage the securities lending life cycle. And that's something that we're looking at to process on a more immediate, accurate, simultaneous basis, and eliminate the need for that reconciliation. So I would say that the technology will continue to move forward with a greater, we've got the flows down now, so let's look at how we make the post-trade more efficient.
Okay, anyone else want to pick up on that?
I'll jump in. So the post-trade has definitely been highlighted as something that needs to be ironed out, and that's within a firm and across the market. Some of the inefficiencies have been highlighted to senior managers who previously maybe had been aware of it but had never been prioritized ahead of other needs. So I think that's something that will change quite quickly in the near term. The big issue with obviously working from home is oversight. So that's again where trading on platforms and provides that granularity that from an oversight or from a compliance perspective is needed. So I think the guys that have had the technology in place, and you can see the revenues coming out on the quarterly results, those are the guys that are well placed, and I think that's those that have not adopted it or implemented some of the technology that's out there will shift to that quite quickly to stay competitive.
Okay. One of the questions that was posed early on was, and again, I'd ask people to bear in mind, this is from the demand perspective. Do we see the role of the agent lender changing post this? Will there be a flatter line from demand to supply vis-a-vis some of the technology platforms that are out there, or just people going direct? Don? I'm glad that I can ask this question and not have to answer it, so I'll ask you.
Thank you. Well, I start by saying I think agent lenders have already evolved. And just to touch back on what Paul and Nancy just said on the post-trade stuff. On the surface, it seems like a fairly simple business. An agent lender lends on behalf of a beneficial owner, over collateralizes mark-to-markets. But it's a very complex business. You start thinking about pledge versus title transfer, pledge of haircut, title transfer on the rest of the collateral, cross-currency. It's a very, very complex business. So I think on the basis of that, agent lenders have already began to evolve. Client demands are changing. Certain clients will look to do direct lending. Other clients will look to do their own reinvestment of cash. Other clients will just outsource it completely. So I think in the current paradigm of an agent lender today, all of those routes to clients as opposed to routes to markets are already established and continue to evolve. Technology will play a big role in that, in making that a bit more efficient going forward. But I think agent lenders have already evolved and continue to evolve in that space.
Yeah, I couldn't agree more. And I think, the agent lender segment of the market tends to respond to the wants of its clients and the demand that comes from the borrowers, and we have to move with that. One last thing I would ask, it's been my experience, and this has been said a few times on a few different panels and get-togethers, that one of the benefits of everyone having to work from home is that bizarrely, or rather counterintuitively, there's been more communication between people, between agent lenders and their beneficial owners, between borrowers and the agent lenders, because there's been this need to over communicate because we can't see each other in person. Do we feel that has benefited the general relationship in that people understand the market more, the beneficial owners understand why the borrowers have the demand they want, and that borrowers understand why beneficial owners might recall that when they've only just lent it, etc.? I certainly feel there's more dialogue, and I'm hoping that is here to stay. Anyone else got a view?
I would echo that. I mean, we see it because we talk to the beneficial owners, the brokers, and the agent lenders. So we're sitting right in the middle, and the communication has increased exponentially. And the level of, as I mentioned earlier, the need for more detailed data and detailed understanding has increased, and that's reflected both from the conversations we have with the Ben owners and also from the agents who are looking to better arm themselves and to provide that information to beneficial owners. And we've seen a lot of fruitful conversations and new understanding coming from the beneficial owner community. So it's been really nice to watch and to be involved with.
Anyone else have a view?
And I think that's absolutely right. the level of communication has been extraordinary, and with that comes knowledge exchange on a more immediate basis than ever before, and I think that's definitely here to stay. It started off with everyone was hungry for knowledge, then they suddenly found they were getting it. Everyone's better informed, and therefore it's a lot more productive and a lot more efficient, in my view.
Yeah, well, actually, and touching on that, a very pertinent question has just come up on my screen here. How sensitive are borrowers and hedge funds going to be to supply stability given CSDR, which is looming on the horizon? Does anybody want to take that?
I don't mind jumping in. And stability is, I think Don alluded to it earlier, it's the key for our client base. We get asked all the time. I mean, how stable is our position? What are you seeing out there? How big is the lending pool? What's the utilization? All those type of stuff. So with respect to CSDR, I don't think that the ask around stability is going to change. I think there's more on us as a PB to just ensure we iron out our supply base and manage our concentration risk versus a certain in beneficial owners. So I don't think they directly correlate. I think as a PB in the middle, we'd need to be managing that on our side. But stability is key for all of our underlying
whilst you've got the floor there, Paul. A question came in that said, what are the best opportunities for beneficial owners in the second half of this year? Now, whilst that maybe doesn't fit directly with the demand dynamics, looking at the demand for the rest of the year, what does your ideal beneficial owner look like?
My ideal beneficial owner, again, it's not going to be overly new, would be one that is open to the broader collateral schedules. But I think the bigger thing for me is the transparency. So if they are looking to put their assets out, if there's going to be a recall with respect to we've obviously seen a lot of rights announced in the recent times. So again, anything around corporate action events, I think beneficial owners that are proactive in providing information up front ahead of if it's a default election, that type of stuff is a very, very key. We've seen a lot of activity on the events on our side. So and the returns on that have been handsome for those beneficial owners that have provided information up front.
Okay, thank you for that, sir. Jack, what's your wish list for second half of the year as a closing statement?
More opportunities like Wirecard, I think. I noticed there was a question that we haven't fully answered on that one. Is how significant is that in terms of how that feeds through to the potential risk of short selling bans? And I think we can't underestimate the vital importance of what has just happened with that. I think of it as an incredibly valuable tool in our arsenal to ward off any future short selling bans. And indeed, BaFin has even apologized for the short selling ban it put on that individual stock last year. But I think, with any market like this, I think my wish list is for markets to show rotation, to show dispersion, therefore to create opportunities for hedge funds on both the long and the short side of their book. And ordinarily, with what is going on in markets and with some of the restructurings that corporates all around the world are going to have to go through, I think this should be good opportunity. So if I'm going to leave a positive message, I think that this is a good environment for certainly stock pickers. On the fixed income side, the last thing I would say, the one thing that does worry me and where we're going to be working hard in the fixed income relative value space, not to see leverage caps being imposed in fixed income relative value. If they are, that will have significant impact in the volumes in the repo market. And I think there's a lot of work to be done there.
Thank you, sir. Right, now we're almost out of time, so I'll ask Don and Nancy 30 seconds each, and this is going to be difficult. How do you see the second half of the year panning out? And to incorporate the last question I've seen today, especially if there's a second wave of COVID. Off you go, Don.
I think that we've made it this far. I don't see a second wave of COVID impacting our business from a business continuity perspective. The impact it'll have on the market is another question. If I knew that, I'd probably not be working. But I think, look, I think we're well placed, and my wish for the future is that we continue to make ourselves more efficient. The opportunities are out there on the front office end. We need to get our back office more efficient so that we can really optimize our returns for beneficial owners.
Yeah, real quick, second half, it'd be great to see broader conviction in the market. We from a beneficial owner's perspective, more specials, more intrinsic value, more money for them, which is great. But to touch on Jack's point, I think it's a real key one, the whole short selling discussion. I know it's very binary. I know there's a lot of good empirical data, but that discussion is still very, very prevalent with certain pockets and sectors of beneficial owners where they still will not lend because of that correlation. So broader discussions along those lines, I think, would be very helpful in going forward.
Excellent. So we're just 2 minutes over time. So on behalf of everyone on the panel today, myself, Jack, Paul, Don, and Nancy, I'd like to say thank you to everyone for joining and listening in.